Welcome back. Recently, I came across this company here, GXO Logistics, and I think this company could benefit massively from, the rapid innovation in both robotics and the continued shift to e-commerce, both very big trends in our world right now. In fact, this is the first company to deploy humanoid robots into, live operations in their industry. And as you might know, there aren't very many publicly traded robotics companies. Tesla is like the only one. So this might be a way to get some exposure to robotics. I've been doing a ton of research on this company in the past few weeks. I've read their annual report or their 10K. I've listened to, the last few of their earnings calls, and I've done some overall research on the industry itself and some of their competitors. And honestly, after it all, this is a company that I've gotten very bullish on for the next decade, really. And I think we're at the early stages of a very dramatic shift and, a boost in productivity in this specific industry. So in this video, we'll dive into GXO's business model, financial health, competitive advantages, potential risks, and also growth aspects. And at the end, I'll share whether or not I think GXO is a compelling investment today. So as they say in their annual report here, GXO Logistics is the world's largest pure-play contract logistics provider, and they offer high value-added warehousing, distribution, order fulfillment, e-commerce, reverse logistics, and other supply chain services. And this company really differentiates itself by delivering these very advanced technology-enabled customized supply chain solutions. And when I talk about those services and say that they're advanced technology, what I mean by that is they're enhanced by advanced technology, specifically automation and AI. As I mentioned, they are the first company to deploy humanoid robots into their live operations, which will just add to their overall efficiency and accuracy and their cost efficiency. When I think about their competitive position, I believe GXO is and will continue to be a leader in the logistics industry because of their high focus on automation and advanced technology. With these things, they're able to provide highly scalable, customized solutions to brands around the world. And as long as they can remain the leader in the technology and offer that improved performance and cost efficiency, I think they will be one of the biggest beneficiaries in the continued shift to e-commerce specifically. But the e-commerce market is not the only market that they serve. They also serve clients in the healthcare industry and aerospace and industrials. If they can utilize their tech to just improve overall efficiency, that allows those companies to get things done quicker and improve productivity. I have a hard time seeing what company doesn't see the value in that. And then on top of that, you have the cost efficiency. So it might actually be cheaper to contract with someone like GXO. And ultimately, right now, I'm seeing this as a whole shift in the entire industry that we haven't seen before. Currently, companies operate their own warehouses because there are no real edges to be found in the industry. However, with the advanced technology and robotics, I think that will change. And I think that will give GXO an edge, in my opinion. Okay, moving on, I want to touch a little bit on the strengths and weaknesses of this company, starting with the strengths and focusing in on the point of innovation. As I already mentioned, they were the first company to deploy humanoid robots. And in the last earnings call, they gave a little segment on the progress they've been making with their AI applications and how this is being received by customers. So here they say, we've now launched 22 instances of our proprietary AI apps across 3 key warehouse functions: proactive replenishment, SKU dimensioning, and order routing. Our tools have delivered exciting results over the past few months, including productivity improvements of 3 to 4 times in stock replenishments for a major sporting good retailer, a 50% improvement in order allocation, plus a 22% improvement in carton fill rate, which drove efficiency and decreased transportation costs for an omni-channel retailer, and a record-setting inbound process for 35,000 SKUs as we prepared to launch a new e-commerce operation. We have a number of other modules in development, including volume prediction, slotting, and pick optimization. GXO's strategy for AI within the 4 walls of the warehouse focuses on improving productivity and debottlenecking the flow of product. So as you can see, their products are already delivering very promising results. The next strength I want to touch on is their existing client base. They're already serving over 100 brands, including massive companies like Nike, Pepsi, and Red Bull, and all of that across 25 different countries. They're already proving that massive brands around the world trust them and see the value in their services. When I look at that, that gives me confidence that they can continue to contract with other big companies out there. And in the past couple quarters, they've been winning deals with companies in different industries, proving that they can scale out of what they're currently doing. So, those were the two main strengths I wanted to highlight. Now, for the first weakness, and that's their debt load. If we go down here to cash and debt, you'll see that GXO has a pretty significant amount of net debt. This is largely from mergers and acquisitions, or M&A, that they've been completing in the past few years to expand into both new demographics and new verticals to expand the type of customers they're serving. One of the top reasons for acquiring new businesses, to me, seems to be to get that insight into serving that industry and get people on board that are already serving those industries from those other companies that they're acquiring, because then they can just take that expertise and apply it in other areas of the world with similar types of companies and industries. That being said, I do expect debt to drop in the coming quarters. And here's what the CEO said about M&A in the last earnings call. Right now, our focus of attention definitely is to get our debt down. Everything focused internally on the business. So M&A in the short term is really off the agenda. And then the second part of this section that I have highlighted is in response to an analyst asking if they're planning on shifting away from Europe because they've been doing a lot of mergers and acquisitions in Europe to the US. So to that he responds, but there's no doubt, having completed a couple of M&A in our Europe arena, we definitely feel that we want to grow more now in the North American business. But especially right now with all the tariff drama, I think this might very well be seen as a good thing. The fact that GXO is so diversified away from the US. The majority of their business is in Europe and in Germany specifically. Another thing that might be seen as a bit of a weakness here is if we look at the free cash flow chart, you can see that it's kind of very lumpy all over the place. This is largely due to those large acquisitions and, they're spending their cash, right? So investors tend to like stable free cash flow, returning value to the shareholder and so on. However, in my opinion, this is a small company. They're focusing their money on expanding and getting more expertise and really growing that revenue, which is growing really fast. Let's see. Revenue is growing, grew 25% in the last year. And another thing that they're spending a ton of free cash flow on, you have to think about when they acquire a new client, there's going to be a lot of capex related to setting up that new warehouse and getting that whole operation set up. So I think you as an investor just kind of have to determine if you're okay with the company reinvesting their cash into the business itself versus funneling that cash to you through dividends and share buybacks and so on. I would expect that a little later on for a more mature company. But as I said, for such a young company, I prefer that they grow their business in revenue. That being said, though, reading the annual report and listening to the earnings call and so on, they do seem to care a lot about returning value to the shareholder. So hopefully they can hold on to that value long term when they start earning more revenue and more consistent free cash flow. They overall talk about this being a very profitable business, so hopefully they can really start returning tons of dividends and share buybacks to shareholders, to increase their value in the future. Okay, moving on to the next weakness or risk that I want to highlight. And I want everyone to be aware of this because I think this is a pretty big risk. It's customer concentration and contract renewal risk. So essentially, GXO depends heavily on a few large clients for a significant portion of the revenue. Now, they don't drop the names and specify which clients those are, but they do mention that that is a risk. And if a major customer doesn't renew or terminates a contract early, that could cause a major revenue hit. And even when contracts are renewed, they may come with lower pricing or tougher terms, especially if for some reason the customer gains more negotiating power. So, yeah, pretty big risk, but with their high technology, the results are speaking for themselves. as long as they can continue to gain market share and win new contracts. You know, if they lose a contract here and there, I don't think it's going to be too big of a deal. The next weakness is high upfront costs and long payback periods. So GXO often invests heavily upfront in custom infrastructure, robotics, and warehouse setups for those new contracts that they win. But if a client underperforms or gets out of their contract early, GXO might not recoup those initial investments. And obviously, that's a major free cash flow and ROI risk. And the last thing I want to mention is low switching costs for customers. Let's say another logistics firm, offers better pricing or terms, and let's say other companies in the future come up with similar technology, a customer can theoretically just switch providers. Or if they feel that GXO's solution isn't efficient enough or worth it to them, they, can go with potentially a cheaper provider or something like that. Okay, let's move on to the financials. So if we look at the revenue here, as I said, in the last year, they grew revenue by 25%. In the last 2 years, 15% roughly. Revenue since 2020 has doubled. So that should essentially tell you how fast they're currently growing. And clearly, those mergers and acquisitions have paid off so far. Let's look at their EPS. EPS, let's change this to the trailing 12 months. EPS is also a little bumpy, but they are profitable. They are generating profits here. So it's not one of those companies that's just losing money. And we already looked at the free cash flow here, but let's take a look at it again on a trailing 12-month basis. So even though they have been, doing a lot of M&A in the past couple quarters, they have been doing so at sustainable levels. And they do end up with free cash flow at the end of the quarter. So as they slow down their M&A, they're going to slowly start to build up this cash again and pay down this debt. And as I said, has been a focus or will be a focus of the company for the next couple quarters. Debt is one of the things that I really wanted to understand well with this company. And I feel like I do at this point. I understand where the debt is coming from. I understand, the path that they've given moving forward. They're going to pay down this debt, which I like. I don't like owning a company with insanely much debt compared to their cash. Okay, now let's move on to the valuation. If we look at the PE down here, the trailing 12-month PE is 31, the forward PE is 13, and the 2-year forward PE is 12. So if we first compare this to their historical valuations, so we're looking at price to earnings in the past 5 years, you can see that they're at, pretty much, pretty low, a pretty low PE ratio historically. Now, if we compare them to some of their competitors, so a 13 forward PE versus DHL, you know, that company's about 10 times bigger. GXO has a market cap of 4 billion. DHL has a market cap of almost 50 billion. Similar PE. However, the size of this company, I wouldn't expect the same kind of growth. If we look at the revenue, I mean, this is not the 25% we're getting with GXO. We have this company too, which is a, contract logistics provider. Revenue for this one, in the past 5 years, 5% a year. They had a little bit of a boom in 2021, but it looks like they're kind of taking off again. We'll look at that forward PE, 26. And then if we compare them to one last company, XPO, and GXO was actually a spin-off of XPO. XPO used to be the parent company of GXO. XPO at this point mostly focuses on transportation, not necessarily the warehousing side of things, and a forward PE here of 24. So overall, on a valuation basis, compared to competitors, GXO is pretty cheap, and they're the leader in warehouse robotics and automation, and their revenue growth is way better than some of these other companies, 25% last year. So overall, I would say this company is undervalued right now. However, keep in mind the risks associated with their contract-based logistics, how companies can just, essentially switch providers. They can give up on their contracts early. They can lose money with high capex and setting up those warehouses, like we talked about. So, with all those risks, I think it's fair that this company isn't valued super high, like in the 20 plus. But at 13, I personally think it's a buy. Lastly, I want to touch a little bit on the growth potential of GXO. So we've mentioned through mergers and acquisitions, they're expanding into new markets, into new industries. And in the last earnings call, they gave this little insight into their sales. Here, the CEO says, third, we strengthened our sales organization in 2024, not only in our traditional verticals, but in new verticals and geographies. These investments have already begun to bear fruit. We closed more than 1 billion of new business wins in 2024, including in strategic growth areas like the health sector and a range of verticals in Germany like aerospace and defense, food and beverage, and omni-channel retail. In North America, we won significant business in the technology sector, including a major contract managing data centers. So that's another industry where GXO could really start to grow and expand in. And if we think about the growth of cloud and AI infrastructure moving forward, that could be a huge industry. Our pipeline is up 15% year over year as of the end of the fourth quarter, and our pipeline in the Americas is up 20%. So they're seeing very good sales growth right now. Okay, to summarize. So overall, as I mentioned, there are some risks with this one and some pretty substantial risks if you ask me. It's not the most stable business, if tariffs affect the global supply chain, this company could really hurt essentially. And if it hurts global trade in any significant way, GXO could hurt pretty bad from that. However, when we saw the revenue growth, it's really good. They also have a clear path forward for their debt, which was a worry of mine. So, I'm feeling pretty confident about that. They say that it's a very profitable business. They're already generating free cash flow despite all the mergers and acquisitions and all these new contracts that they're winning. The valuation on this one is looking pretty appealing. I have no worries there. Compared to historically, they're pretty low. Compared to their competitors, they're low. And they're the leader in the technology in this industry. And as I talked about, I really think that we're going through a shift in this industry. And the productivity boost, I mean, we heard the numbers, the actual results that they're getting in terms of productivity. So especially as e-commerce continues to grow and these major brands see the benefit of consolidating all of their warehouses into one big efficient warehouse, it's going to be a lot of e-commerce, so they just send those products. Doesn't matter where they're located. And I think GXO is going to be a huge beneficiary of that continued shift. Right now, I hold barely any shares. I started with half a share as just like a watcher position just to see where the company went since I started looking into it. But I expect that I will start to add pretty heavily to this one because I'm investing overall in my portfolio. I'm investing pretty heavily in AI and robotics. And I think it's a generational buying opportunity because we're at the start of this technology. That being said, though, I don't think I can see myself making this position more than 10% of my portfolio, just because it is a little more speculative. It's not as stable of a business as some of my other companies that I hold. And some might think that 10% is even pretty aggressive. But keep in mind, for me, I'm okay with that risk, especially this early on in my life. And I do see great opportunity with this company. So, yeah, I'll probably start buying this one in the next couple weeks. But that'll be it for this video. If you found value in the video, drop a like. Let me know what you think about GXO in the comments below. See you in the next one.